Welcome to the Company Value Investor channel. In today's video, we are going to analyze two companies. We're going to analyze the Target Corporation and CVS Corporation. And this is by request of an individual named Alex. Alex would also like to get a sense of how I collect the information to analyze it. In other words, he wants to know how I make the selections to generate the companies that I analyze. Okay, so let's start. Let me give you guys a brief understanding of how I collect the information. So I have here in my program, I have basically 5 different subjects that I can choose from. Okay, these are the top gainers. So what happens is the program goes and collects the top gainers for that day based on the stock market and puts them here for me to make the selection. Here I select whatever amount that I'm looking for. If I'm looking for stocks that are between $50 and $30, I hit it and it'll give me the actual companies that are within this range, the 50 and 30 stock range, that were classified for that day or the previous day, if it's non-trading hours, as a top gainer. Again, if I want to focus on the most active stocks between 30 and 30, I make that selection and it gives me the list of those stocks. It has 5 different basically subjects. I can go as high as I want to. I can put 100 to 30. I can put 1,000. It just depends. If I want to focus on small amounts, let's say $15 to $5, it'll still give me a list. So depending on what I'm looking for, then that's what I select. So basically, at the end of all this, I have 5 different subjects that I make the selection. I place the amount that I'm looking for, and then the program goes in and gathers that information for me. I hope that was clear. So now let's go into the actual analysis of the corporation, the Target Corporation. So again, I make my selection here. It's actually already there, Target. Here it is. I make my selection 2017. The symbol for Target is TGT. This is the current information. This is the current price. On the left side here, we have the profitability and the ratios that most or a lot of financial gurus use to make and conduct their analysis. At the bottom here, we have the information that's generated from the financial statements, the income statement, the balance sheet, and the cash flow statements. And basically what happens here is these ratios here, the profitability, leverage, and liquidity ratios, are nothing more than one of these numbers divided by another. So what we're looking for is 4 basic pillars or 4 basic sections to conduct our analysis, and that's the rate needed, the amount expected, the amount made, and the amount needed. What I'm looking for is, on the rate needed, is that the current rate of return is very close to the cost of capital. The reason being is because it tells me that the company is actually meeting the expectations of both the creditors and the owners. Here on section 2, the amount expected, this is the amount that the capital needs in order to meet its obligations. Any positive number here, it shows that it's a good, well-managed company. Basically what this section is, it's the performance appraisal. Section number 3 is the real earnings, not the net income or the net profit. This is the net income for 2017 for Target. This is the real earnings. And section number 4 is basically the amount needed by the corporation to conduct daily operations. So taking all these 4 sections into account, we can conduct an analysis and decide whether this company would be a good investment to invest in. Okay, so in 2017, everything is green, meaning the stock is strong, the stock is undervalued, and the company is very profitable. And the reason why we see this is because, again, the rate of return is very close to the interest needed. That's a good sign. It made real earnings, which surpassed the amount expected, which is another good sign. I'm not too worried about number 4, section number 4, because most corporations in the US are going to have a negative number here. So in 2017, they had negative cash flows. Here in this section, we have the basically the cash flow statement, and then here we have an amount showing if we were to spend $10,000 today, a year from now, it would give us either a profit or a loss. And this information, basically the rate comes from here, from the rate needed. So in 2017, Target company was very profitable. Although they had negative cash flows, they had real earnings, and the reason why they probably had negative cash flows is because they made some financing activities. Oh, they have 2018 information. So in 2018 again, the reason why they're not profitable here is because they have an amount that's expected that's a little higher. But other than that, it's a pretty good company, because they missed it by a few. The amount expected is only over by a few numbers, not by a lot. They have real earnings. The amount needed is still around the same. And again, the rates are almost the same, within 2 and 3 percentage points. So in 2018, the company was actually, they have positive cash flow. So that's another good sign. Let's check 2016. 2016, everything is green, meaning the company's profitable, the stock's undervalued. And the reason why it's undervalued is because they're actually very close to the interest rate here, and the price to ratio, and the PE ratio, and the earnings per share, and all that. They all come into play. The beta is also very good. So the question is, would I invest in the Target company? Yes, I would. It is a good company. For the last 2-3 years, they've had strong earnings. They've had real earnings. They've met their obligations to both the owners and the creditors, and their amount that they need to run daily operations has been stable. Okay, with that being said, again, I would invest in this company. It is a very good company, very profitable. Let's go to company number 2, the CVS Corporation. And let's go to 2017. The current stock price per share is $66. Current information here. Okay, this is a good sign here. The rate needed. The current rate is 13%. The interest that cost of capital is almost 11%. It is a good sign here. The amount expected is negative. However, they did have real earnings, and the amount needed is here negative. The reason why it's showing not profitable is because the amount expected surpasses the real earnings. But even though you see a much higher number, it is still a good company because it had real earnings. If I was to spend $10,000 today, a year from now, I would make for almost $500. So in 2017, they had negative cash flows. They spent most of their money capital financing activities. They did have a large amount in operations, so that means that the company is well managed, and it basically runs its operations very efficiently. Let's go 2016 again. The rate still 10.5, which is good. The real earnings are still very good, and the amount expected that they expect to earn in order to meet the obligation is still about the same. The amount needed is still about the same. So let's go to 2015. Again, very good company. The only reason why it keeps showing not profitable is because the amount expected, their appraisal performance, surpasses the real earnings. But other than that, it is a good company. It is a strong stock. The stock is undervalued, so it's going to go up. If you were to invest, say $10,000, you would have almost a 5% increase by the end of the year. So if you invest in this company, if I was to invest in this company, I would see a profit. The question is, would I invest in the CVS corporation? And the answer is no. And the only reason why I wouldn't invest, even though I'm saying it is a very profitable corporation, the only reason why I would not invest is because of section number 2. In all 3 years, I think, yeah, in all 3 years that we analyzed, we saw that the amount expected was always constant, but it always surpassed the amount made, meaning that although they made very good earnings during these 3 years that we analyzed, they were not able, or they did not attain a positive amount here, which means that it's not an excellent performer. It is a good performer. My criteria is you have to, out of the 3 or 4 years that we analyzed, you have to at some point have a positive number in the amount expected. That is my criteria. However, it is a very good company. It is a very efficient company. It's very profitable. They make real earnings. Maybe in a couple of years they'll turn this around and they'll be able to show a positive number here in their performance appraisal, the amount that expected. With that being said, that is it. I hope, Alex, that I was able to answer your question, and I hope that the analysis of the Target and the CVS corporations were to your satisfaction. If you have any more questions, please do not hesitate to email me or post them under the comments. Again, take care and be safe.